every 18 hours, a new real estate project launches in Dubai. But how do you know if it's a smart investment? In this video, I'll take you through a comprehensive analysis and show you exactly how to run the numbers to determine if a property is worth your money. Most of these insights have never been shared online. Until now. I am a former management consultant and banker, and now I lead a team of real estate experts who help investors make data-driven decisions in Dubai's real estate market to achieve the highest possible returns. I'm about to reveal our internal playbook, which starts with defining a budget. Because the range of prices in Dubai is super broad, starting from roughly $150,000 up to tens of millions. So it's important to set your range up front. Let's start with Dubai market averages. Studios are around $220,000. One-bedroom apartments $360,000. Two-bedroom units $650,000. Three-bedroom apartments over $1 million. The average villa is $1.4 million. By definition, an average means that there are more affordable options as well as more premium ones. Let me give you several areas as examples. The relatively affordable area GVC, not far from the city center, has several parks and is great for investors looking for high rental returns. Good studios start at $170,000. A one-bedroom would cost $250,000. A two-bedroom is $400,000, and a three-bedroom would be roughly $550,000. All of these are below the average. Now let's take a look at the prices in Greek Harbor. It's a higher-end area with a beautiful marina promenade. It is claimed to become the next downtown, with the next largest mall and the tallest building in the world. So it should be considered for long-term value appreciation. Prices. Studios. There are no studios. The minimum is a one-bedroom and they start at $430,000. A two-bedroom is roughly $700,000. And a three-bedroom would be about $1 million, almost 2 times higher than GVC. Now let's say you are looking for a villa for a family in a nice green area, and you also love playing golf on weekends. Then Dubai Hills is your choice. An average price for the 3-bedroom villa here is $1.9 million. 4-bedroom villa is $2.2 million. 5-bedroom is $3.3 million. And 6-bedroom is $9.7 million. Now that you've got an idea of the price range, it's time to set an investment goal. And different goals mean different success criteria, and therefore different properties will be considered suitable. Here are the goals you might have. First, saving your money securely. You might have made some money that can be invested in real estate and reliably saved. This is for investors looking to hold property for many years, those who want to maintain stable returns and very low risk. This is more of a preservation strategy. Second, maximizing long-term profits. This is for investors who are okay with less stable income streams, but are aiming for the highest possible returns over a long period of time. The planning horizon for such investments should be 5 to 10 years or longer. It better suits those who have other sources of income and will not fully depend on the property. Third, quick profits. This is for investors who want to exit the investment quickly with greater returns. Pursuing this goal is associated with the highest level of risk and is not recommended for those who are new to the market. And fourth, living in Dubai with future growth potential. If your plan is to live in Dubai, then you'll want a home that suits your lifestyle, but also appreciates in value. This involves balancing lifestyle requirements with investment considerations. Now that you've decided on your budget and goals, it's time to look for a property. But where to look? Basically, it is determined by your investment goals. Let's define the scope of the search. For safe, long-term savings, you should focus on areas with the highest rental yields. An indicator of high rental return potential is the rent-to-price ratio. It is calculated by dividing the annual rental income by the property price. It is a simple metric, but it should be enough for an initial analysis. Here are the 25 Dubai areas with their rent-to-price ratio. The range is from 4.6 to 9%. These numbers are the averages calculated by the property finder, so please do not jump on conclusions based on them. But what you definitely can do is pre-select the areas for further exploration. So pay attention to these 5 areas: Al Furjan, GVC, Sports City, International City, and Arjan. These 5 areas have the highest rent-to-price ratio and therefore should be on your consideration list. For quick profits, the key is to find properties that will appreciate fast. These either can be off-plan properties or properties listed below market value. Here is what you need to look for in off-plan properties. Prime unit. Choose units in desirable locations within developments. For example, high floors with the best views. Limited inventory. Fewer units means higher demand, allowing you to sell at a premium. Rising market prices. Make sure the general market trend is upward. Otherwise, this strategy becomes much less favorable. Developer sold out. If the developer hasn't sold out their inventory, buyers will likely to purchase from the developer directly, rather than paying a premium for your resale. For ready properties, you are looking for one of two things. First, distressed sellers who need liquidity and are willing to sell at a discount. This is where you can make a significant profit if you buy below market value. Second, consider properties that are in desirable locations but can benefit from renovation. With improvements, you can increase the value and sell at a higher price. If you are looking to maximize long-term profits, focus on areas and projects with the highest growth potential. Here is what to consider: undervalued properties. Sometimes a property is valued below the market standard for its type. Such situations usually involve some risks. Often it's because the developer's reputation is not yet established. It doesn't mean they are bad, they might just be new to the market. Buying from them can be an option, but only if their reputation outside Dubai is solid and you've thoroughly checked their contractors and architectural firms. Early stage projects in early stage areas. This option has the most potential. The main tactic here is to choose a great unit in an area that's excellent for investing, but is currently at a very early stage of development. Here's the list of areas that will be developed in the near future. Many units will appear on the market from time to time, so you'll have your chance to invest. But it's not like you can pick any random one, because they're different. Different developers, different levels of quality, different pricing, etc. So choose wisely. By the way, you could live in any of those places if you want. However, the implication for your investment case is that you won't be generating rental returns. And since the area is not fully developed, there can be a lot of construction work around, and infrastructure might not be completed. So if you don't want to wait until the infrastructure is in place, then the option can be early stage projects in developed and growing areas. There are some areas in Dubai that are just great, loved by expats and tourists. More people want to live there than buildings can accommodate. And, once in a while, a rare new project appears. New buildings are often more desired by those who want to live in the neighborhood. So such a project might be a great opportunity if it is well priced. Here are some examples of the developed areas that were growing significantly faster than the average in the last 3 years. There are no guarantees they will continue outperforming the market, but these areas have their competitive advantages, so they're worth investigating. And if your goal is to find a place for living and investing, you can search among these areas as well. Here criteria vary depending on personal preferences. To make this video as practical and valuable as possible, we will select a project and do an investment case analysis for it. Let's say we're looking for a 1-bedroom and are considering One Sky Park by Iman Developers. This is an off-plan project located in Jumeirah Village Circle. It is created in collaboration with Versace Ceramics, which promises that the interior design will be special. The building will feature 2 pools, including a rooftop infinity pool, sports spaces like a basketball court and a paddle tennis court, a rooftop cinema, kids play areas, and many other amenities for comfortable living. One bedrooms start here at $325,000. For this money, you will get a 706 square foot apartment, which will be completed in 36 months. But how will we measure the investment attractiveness of this property? Here are a couple of metrics we will use. First, cash-on-cash return. It measures the cash you are making on the money invested in the property. Basically, it's a quick way to evaluate the percentage paid back by rent. And the higher the number is, the safer the investment. Even if the value doesn't appreciate, the investor would still make money from rent. Second, ROI, or return on investment. It measures the overall profitability of the investment, combining both cash flow and property value appreciation. But how will we know that the results are good or bad? They should be compared to market average and other investment properties on your consideration list. This way you'll know which investment option to choose. Another thing you could do is compare the ROI of this investment with the ROI of alternatives. For example, your best alternative could be putting money in the bank and getting interest on your account. Ideally, before comparing these numbers, you should discount them by the risk factor. But this exercise is much more advanced, and we won't go there today. So let's start crunching numbers. The first thing we should do is calculate the property acquisition costs. These are basically the size of the investment that needs to be made. The number would be different for off-plan and ready secondary properties. For off-plan, and let's use the example of One Sky Park that we selected for our analysis. The biggest cost driver is price, of course. Then we have a 4% Dubai Land Department fee and small administrative fees paid to the developer, usually around $1,500. And that's all. In the case of a one-bedroom apartment in One Sky Park, it totals at $339,500. For secondary, we also pay the price and the 4% DLD fee. Here we don't have administrative fees, as the developer is not participating in the transaction. But there are trustee services, which are around $1,500, legal advisor services to check the contract, roughly $3,000, and agency fees, which are 2% of the property price. In the case of our project, it totals at $349,000. Two notes about agency fees. First, 2% for ready property is a market standard. If someone asks you for more, then you'd probably better find another agent. Second, there are no agency commissions on Dubai's primary real estate market, as agents are compensated by developers via standard agency fees. So if an agent asks you to pay the commission, then you're likely paying for nothing. Now, let's talk a little bit more about prices. How do we know that the price is good? Well, for secondary property, this is easy. Just compare to other units. The trick here is to compare the asking price to transaction price, not to listing price. The good news is that Dubai's real estate market is quite transparent, and you can always find the historical deals. Go to dxbinteract.com, click on Transactions, select an area or a project, enter the property parameters, including the type and the number of beds. Click Search and enjoy the quite detailed list below. Obviously, off-plan is different. The key is to find the correct reference point. Ideally, we're looking for building in the same area, which is very similar to this one, meaning the same or very similar developer and the same class of property. If there are no good reference points in the same neighborhood, then what about other areas? How is this developer priced versus the market when the building is completed? Well, now let's spread the property acquisition costs over time and discuss payment plans. Off-plan first. Developers offer structured payment plans where a part is paid before the construction is completed and another part after the handover. These plans typically look like 50-50, 70-30 or 90-10. Usually, more established developers have stricter payment plans. MR, for example, usually has 90-10. That's because they often sell out the building in several hours after the project is launched. so there is no point for them to offer flexible payment options. The usual down payment in Dubai is 20%, but don't forget that you also pay a 4% DLD fee, and you do that at the beginning. Obviously, the payment plan affects your investment case a lot, especially the terms about the frequency of payments and what they are tied to. During the construction, the payments are usually tied to construction phases. Developers usually provide an estimated timeline, with the payments scheduled quarterly or monthly. It makes everything look quite predictable, so you could easily plan the cash flow ahead. However, there is a nuance. Imagine if the construction work has not reached the next stage yet. Well, it means that you don't have to make the next payment for now. But what if the construction goes faster than expected? This is good, you'll get your property sooner. But it also means that you'll have to make the payment sooner. This is why having the full sum in quick access if you entered such payment plans is critical. After the construction is completed, there are basically two payment scenarios. First, you pay all the outstanding balance in one lump sum. Second, you have a payment schedule, and it's becoming more common to have 30% to be paid over 30 months after the construction is finished, like 1% each month. Please note that this means that you must manage the money logistics every month to not miss the deadline. It's quite a hassle if you live in a country that is limited in cross-border payments. What else you should know is that flexibility comes with a price tag. Such post-handover plans increase the price per unit by up to 10%, making your ROI lower. But if you plan to rent out the property and you don't want to take your money out from another investment, then it can be an option, because the rental payments might cover what you need to pay according to a payment plan. Those who aim at flipping the property and making fast profits should focus on payment plans where a lower amount is paid during construction. This potentially allows for a high return on investment, as the investor is not investing the full amount. Let me walk you through an example. The investor selects the 50-50 payment plan for an apartment that costs $200,000. 50%, which equals $100,000, will be paid during the construction, and the remaining 50% in one payment after the construction is finished. In 2 years, as completion approaches, the price has gone up by 20% as the market grew and the property became more valuable since it's now an almost ready project. So the investor decides to sell at a price of $240,000. 100,000 of this will go to the developer to cover the outstanding payment, and 140,000 is what the investor gets. By this moment, the investor has spent just 100,000 as the first 50%, plus 8,000 of DLD fees, and roughly 1,000 of administrative fees, a total of $109,000. This makes the total return on investment in 2 years 128%, and this 28% extra was made in just 2 years. This is an absolutely simplified scenario. In reality, many things can kill this investment. First of all, what if the market goes down? In this case, the investor would sell lower than they bought. Second, what if the investor hasn't found a buyer that fast? In such a case, it's critical to have the amount needed to cover the outstanding balance, or the investor will have to sell at a big discount. All of that being said, let's get back to our exemplary investment case. Let's say we're choosing between two payment plans, 50-50 and 70-30. Note that in reality, Iman's payment plans can be different, and this example is used for educational purposes only. Let's place the payments on the timeline. In the case of a 50-50 plan, your upfront investment will be almost $80,000. Then you'll pay $32,500 for the 3 years until the construction is finished. And in year 4, you'll pay the outstanding amount of $162,500. For the 70-30 plan, your upfront investment will be almost $86,000. This difference comes from a higher price, and in our case we assume that it would be $352,000. This is at $27,000 higher than the usual plan. During the construction period, you would pay almost $59,000 every year, and after the construction is finished, your payments would be $42,000, $42,000 and $21,000, because you would pay 1% of the total price every month. A couple of words about the secondary market. The most important difference with the off-plan is that it's possible to get a mortgage. It's a less common thing among foreign investors because the down payment will be 40% compared to 20% offered to residents. Approval rates are lower, and even if approved, the interest rate will be significantly higher. Now that we have discussed the property acquisition costs, let's dive into operating expenses. No matter how you manage your apartment, one cost bucket will always be present: service charges. These are the fees you pay to the developer to maintain the property. Their amount differs based on the area, type of building, and the developer itself, and is normally in the range of $3 to $6 per square foot per year. These charges are significant, as a normal one-bedroom apartment can easily have $3,000 or $4,000 per year in service charges. Also, the owner pays housing fees collected by Dubai municipality if the apartment is not rented out. These are 5% of the annual rent value of similar properties. But if you have long-term tenants, they pay it. And generally, if you rent out the apartment for the long term, you don't have any other operating expenses. The tenant covers all the utilities and even handles the maintenance costs. Tenants are obliged to hand over the property in the same condition as it was at the start of the rent. Even the realtor commission is covered by tenants. But if you decide to live in the apartment yourself and do not rent it out, then your usual costs will be the same as if you had rented. We won't include them in the investment case, but they are quite standard. Water, electricity, gas, internet and TV, and sometimes AC. In the case of our project, our plan is to rent it out. So the only cost bucket is service charges. In One Sky Park, they are about $5 per square foot, and the whole area of the apartment is 606 square feet. Therefore, the annual payment would be around $3,500. So, we're done with costs. Let's finally get to revenue. We'll start with rental revenues, as this value stream is the easiest to predict. To do that, we need to determine the current rates. For this, we need to find the most comparable benchmarks. It's really easy in the case of secondary properties, as there are other similar units in the same building. But off-plan is more tricky. How do we do that? First of all, the area. We'd better look in the same neighborhood. If the area is not yet built, we should find the most similar one. And if the most similar one is already developed, then we should discount from that, as our new area will need time to gain value if there isn't much around. Second of all, the building. We need to find the most similar one, ideally the same developer and the same class. Comparing Shoba to Azizi can be a bad idea, as well as comparing Address by MR, which is a premium building, with a more simple MR residence. If this is the first building the developer builds in this area, and this is quite a frequent case, we should find the closest match from a similar developer. Or, if there are none, we can try to estimate the numbers relative to the developer's performance in other areas. For example, if Ellington units are usually rented out for 10% more than similar select group units in the same area, then we can apply the same ratio in our case. Third, the type of unit. Things to consider: apartment, townhouse or villa, number of bedrooms, studio, one bedroom, two bedroom, etc., square footage, floor, view, furnished or not. When the current rates are clear, it's time to project growth, because rent increases year over year in Dubai. What we do is also take a look at the growth benchmarks at the unit level and the area level, because sometimes units were handed over not long ago, and therefore we have no historical growth. To be clear, we almost never should continue the growth trend at the same pace. Usually, it's overly optimistic. It makes sense only if the area development will significantly speed up, or such units are extremely rare and will be in even higher demand. Otherwise, there is no point in assuming such growth, as you want to be on the safe side when modeling the investment case. If you are not, you can end up expecting unrealistic returns. But overall, here are a couple of other ways to approach the numbers. If you want to be super conservative, just assume that the rent rates will not grow. A realistic projection is somewhere in the middle. Since 2020, Dubai rent grew by roughly 10% every year. Right now, to be on the safe side, it should be okay to say that Dubai rent will grow at about 5% rate annually over the next 3 years. Another thing you should consider is that you cannot just increase the rental rates whenever you wish. In Dubai there is a regulation protecting tenants. The government body called RERA, Real Estate Regulatory Agency, calculates the average market rate index for each neighborhood. Here are their conditions. If the current rent is less than 10% below the market value, no increase is allowed. If the rent is 10 to 20% below the market value, a maximum increase of 5% is allowed. If the rent is 20 to 30% below market value, a maximum increase of 10% is allowed. And so on, with a maximum possible increase of 20%. So, if there is a market average growth that allows an increase, the owner must provide 90 days notice. And if they didn't, they must wait for 1 more year. By the way, kicking out the current tenant and finding a new one is not an option either. Reasons for evicting the tenant are limited to 4. First, personal use, meaning the landlord or their immediate family intends to occupy the property. The landlord must provide proof of this intention and give 12 months notice. Second, sale of the property. In this case, landlord also must notify the tenant with 12 months notice. Third, significant renovations or redevelopment. If the property requires major renovations that make it uninhabitable, the landlord can refuse to renew the lease. This also requires a 12-month notice. And fourth, tenant's breach of contract. If the tenant violates the terms of tenancy agreement, for example, by not paying rent, in this case the landlord may refuse renewal. So, this is not that easy. And anyway, looking for a new tenant also takes time. It is possible to rent out the apartment in a matter of days, but it will most likely take you longer, especially if you will not underprice it. Conservatively, attributing 8% of time to be underutilized is a fair assumption. Now, let's apply all these inputs to our project. We did our research and made a comparison group consisting of similar buildings in the area. Most of them are built by the same developer. The key comparison project is Oxford 212 by Iman Developers. It is also located in GVC, has superior quality, and a lot of cool amenities, like a rooftop pool and a rooftop cinema. The base rent for a 1-bedroom in the comparison group is $28,600 US per year. The main difference is that One Sky Park is branded. Its interiors are created in partnership with Versace Ceramics, so it will be more in demand and rental rates will be higher. We should expect at least 10% higher rates than in our comparison group. Usually branded buildings have a bigger difference, but they are normally in the premium segment. Now, growth. For the last 3 years, 1-bedroom rental rates grew by 18% every year, which is quite a decent growth. But if we take the period since before COVID, the growth rate was 5%. Since GVC is quite developed in terms of infrastructure and the supply of units is growing, we do not see reasons to continue the recent growth trend. So let's go with 5%. Also, we assume that we will have new tenants every 3 years, and we will need about a month to find them. So, here are our rental returns on the time scale. We would not make any rental income during the first 3 years, because the building would be under construction. In year 4, we would start making money with $33,500, which could grow to $45,000 in year 10. Let's place this number next to the expenses. It seems that this revenue won't be enough to cover the service charges and post-handover payments, even in a 70-30 plan until year 6, but it still covers a big portion of the costs. By the way, there is a way to make higher rental returns by renting out for short term, like on Airbnb. Pros: the returns can be higher because the unit will be priced at a premium. Cons: you will need a higher investment amount and you would need to furnish the apartment, and the revenue is less predictable. Dubai has high and low seasons, so it affects the occupancy rate. The perfect units for short-term rent are usually located in the hottest tourist spots. GVC is not one of them, but there are short-term rentals also. If successful and such property is utilized for more than 80% of the time, it can generate 20% more income after management fees. But do not forget that you would need to invest into furniture and custom design. This can be an extra $10–15,000 for a one bedroom. Alright, we figured out the rental income, and now it is time to estimate potential asset value appreciation. I wanna start with a disclaimer. No one can see the future and know for sure what the growth rates will be next year. At least no one I know. But what we can do is make different growth scenarios. Conservative, realistic and optimistic, and project the growth based on them. This still will not take into account crises, wars, pandemics and other macro shocks, because they're the black swans and they're unpredictable in most cases. We need to start with a market forecast, meaning how we think the prices will act on average. Here are some data points to consider. The average 10-year price growth in Dubai real estate is 3%. As this period contains different economic phases and includes the COVID crisis, this number can be considered conservative. Most of the real estate research agencies forecast 6 to 11% growth potential for 2025 and 2026. We internally agree that this range is reasonable. According to developers' construction plans, it seems that Dubai potentially has at least 2 more years of undersupply. And to be on the safe side, we'll take 6% for our calculations. But markets are not created equal, and within Dubai there are some types of properties that will grow faster or slower than average. For example, Blue Waters grew by a crazy 143% in 3 years. And if we take a broader look at the so-called average waterfront properties that also include The Palm, Beachfront, JBR and La Mer, then the average growth of such areas would be 69%. So we can say that the waterfront cluster growth is 69%. This performance should be analyzed relative to the market. In our case, the property is located in GVC, so we need to make a scenario for this area. Here are the main considerations. Historically, it grew by 36% versus 30% market growth during the last 5 years. That's close. Many new projects are planned in GVC, so there are no signs that the demand-supply balance will change in a way that the properties here would be scarce. The area still preserves its competitive advantages, so we can assume that it will grow with the market. Now we apply the 6% market growth in the next 2 years, and then 3% as it was the market average for 10 years. So, assuming that our property grows with the market, the apartment value will be $463,000 in 10 years, which is a 42% increase from now. But that's not all, as our building is under development and its value may grow faster than the market. It isn't always the case, as sometimes the growth does not happen upon completion. Here are some factors that we should make sure are not present in our case. First, the project could be overpriced from the beginning. In this case, it doesn't matter if the next buyer in 2–3 years from now will have lower risks. The price will not grow because similar buildings in the neighborhoods have a lower price for similar units. Second, some developers deliver a lot of very similar units at the same time. It means that the market will be flooded with apartments that are all the same. Of course, buyers will have higher negotiation power, and sellers would not be able to resell the property at a higher price. In order to estimate this growth correctly, we can look at the previous price growth in similar cases. We should look in 2 places: same developer buildings or different developers but similar buildings. For example, if we wanted to estimate such growth for an apartment in a new waterfront area, we could look in other waterfront areas. We did such analysis for our project, and this extra growth reaches up to 25% in the comparison group. For modeling purposes, we assume that the selected property will gain an extra 10% in value upon completion. and we make this number low intentionally to be more conservative. These 10% are additional to the growth driven by the market. So, here is what we've got. According to the estimation we just made, the total value of the apartment could reach more than $500,000 in 10 years. This is a 55% increase over the current $325,000. Now let's put it all together and calculate our metrics for both payment plans. First, 50-50 plan. According to our investment case modeling, the total spend in 10 years would be $378,000. Rent would generate $275,000 and selling the apartment would bring us an additional $503,000. What it means? Cash-on-cash return would be 73%. A small reminder, this metric shows what share of invested amount can be paid back by rental returns. This is a solid result, which also takes into account that 3 out of 10 years the building was under construction. So if we would wait a little longer, say 2 additional years, it's likely that the rent would pay back the whole investment amount. ROI would be 206%. This includes both rent and the value of the asset and illustrates how our total returns compare to the invested amount. So in case you'd sell the apartment in 10 years, you would more than double your initial investment. Let's quickly take a look at the same metrics for the 70-30 plan. Here the numbers are a little lower. Cash-on-cash returns are 68% and ROI is 191%. The difference comes from the higher apartment price because of the more flexible payment plan. Overall, these numbers are not bad, and 1 bedroom in one sky park could be a great investment, especially for those who are looking for a reliable option to save money and generate decent long-term results. The good news is that new projects launch in Dubai all the time, and we analyze the investment attractiveness of the most interesting ones on this channel. If you want to take a look at one of them, you should check out this video.